Hello and welcome. Today, we'll be discussing geopolitical risk within the realm of portfolio construction. I'll be your host. My name is Desai, and I'm a product manager here at Van Eck. In 2025, geopolitical risk has transitioned from being background noise to a key factor in influencing investment decisions. We're talking about escalating global conflicts, rising protectionist policies, and the volatility of capital flows. So today, I want to walk you through how investors are thinking about risk, and more importantly, what you can do to position your portfolio for resilience in the world that feels incredibly unpredictable. Let's start with why geopolitical risks matter. It comes to no surprise that events like armed conflict, government sanctions, regime changes, and diplomatic standoffs can be largely disruptive to global financial markets. In the recent past, geopolitical risk has been somewhat of a side plot, but today geopolitical risks are rewriting the investment strategies for market participants. Here in the US, we're seeing what Jan Van Eck recently called the 3% reckoning. After years of stimulus, governments are now slamming on the brakes, cutting spending and reintroducing tariffs to the tune of about $1 trillion. That's roughly 3% of GDP. That shift is showing up in corporate earnings, jobs data, and investor sentiment. And it isn't just noise, it's structural change. What exactly are the top geopolitical risks that investors are facing in 2025? First, escalating global conflicts and instability. Armed conflicts across the Mideast and Eurasia have disrupted energy markets and have initiated renewed pressures on global inflation. Additionally, the trend towards protectionist trade policies, including increased trade barriers, tariffs, and disruptions to global trade. Domestic tariff policy continues to induce market volatility, and I expect materially higher tariff policies than the market has been accustomed to in the past 90 years. Finally, significant shifts in capital flows, with some investors potentially moving away from US dollar-denominated assets, including those that have historically been considered safe havens during market turmoil. Capital seems to be shifting towards currencies and markets where policy may be more predictable per se. Even here in the US, emergency tariff announcements triggered a sharp sell-off in April, followed by a dramatic rebound when the White House paused implementation. That's how quickly sentiment and portfolios can swing. How do you position your portfolio for this upcoming market turbulence? Step 1 is look beyond conventional asset allocation models. The traditional 60-40 model is inherently flawed in this market due to its explicit exclusion of real assets. Real assets, including gold and other commodities, tend to perform really well in volatile environments. Our Wealth Builder Plus and Wealth Builder Core strategies are designed to help investors with a comprehensive asset allocation for markets just like this. For a dedicated, diversified real asset exposure, consider the Van Eck Real Assets ETF, ticker RAAX. Step 2, hedge with scarce assets. Gold continues to be a proven geopolitical hedge, and increasingly, investors are turning to Bitcoin. Step 3, diversify geographically. One region we're incredibly bullish on is India. It's one of the strongest structural growth stories out there, and if you're looking to diversify internationally, consider our Van Eck Digital India ETF, ticker DGIN, or the India Growth Leaders ETF, GLIN. Both provide efficient access to a high-growth market with strong macro tailwinds. In closing, as Jan Van Eck said in his latest outlook, stay invested but diversified. This is a process, not a moment. So don't panic and position smartly. And if you want to stay updated on how Van Eck is navigating the current macro environment, be sure to subscribe to our latest insights. Thanks for watching and stay resilient out there.